In 1948, a college professor put $712,000 into a tiny car insurance company that nobody on Wall Street cared about. That single investment would go on to generate over $400 million for his shareholders. And decades later, his most famous student would turn that same company into one of the most valuable businesses in America. This is the story of GEICO, and it might be the greatest investment case study ever told. Welcome to the Daily Investor. Today we are diving into a case study that spans nearly 90 years, connects two of the greatest investors who ever lived, and teaches us something profound about what makes a truly great investment. We are talking about GEICO, the government employees' insurance company, and how it went from a tiny niche insurer to the crown jewel of Warren Buffett's $900 billion empire. By the end of this video, you will understand exactly why both Benjamin Graham and Warren Buffett bet their reputations on this one company, and what that teaches us about finding great businesses. This is educational content, not financial advice. Always do your own research. In 1936, a man named Leo Goodwin Sr. had a simple but radical idea. What if you sold car insurance directly to customers and cut out the middleman entirely? At the time, every auto insurance policy in America went through an agent who took a commission. Goodwin figured that if he skipped the agents and sold straight to safe, reliable drivers, specifically government employees, he could offer the same coverage at 30 to 40% less than anyone else. He and his wife Lillian started the Government Employees Insurance Company in San Antonio, Texas, with $25,000 in capital. The business worked. Government employees were statistically safer drivers, and without agent commissions eating into margins, GEICO could undercut everyone on price while still making a profit. Now here is where the story gets interesting. In 1948, a quiet, analytical professor named Benjamin Graham, the man who literally wrote the book on value investing, discovered GEICO. Graham's investment fund, the Graham-Newman Corporation, bought roughly half the company for approximately $712,000. Think about that number for a moment. Half of an entire insurance company for $712,000. That is less than the price of a single house in many cities today. Graham saw what most of Wall Street missed: GEICO had a structural cost advantage that was nearly impossible to replicate. When your competitors have to pay agent commissions and you do not, you win on price every single time. That is what we call a durable economic moat. There was one complication. The SEC ruled that an investment company could not own more than 10% of an insurance company, so Graham-Newman was forced to distribute its GEICO shares to its shareholders. But the investment was already set in motion. Over time, that $712,000 stake would grow to be worth more than $400 million to those shareholders. In January 1951, a 20-year-old kid from Omaha, Nebraska, was studying at Columbia Business School under Benjamin Graham himself. His name was Warren Buffett. When Buffett discovered that his professor was the chairman of GEICO's board, he did something that most students would never think to do. He took a train to Washington, D.C. on a Saturday morning and showed up at GEICO's headquarters unannounced. The building was locked. Most people would have turned around and gone home. But Buffett banged on the door until a janitor let him in. He found one person working that day, a vice president named Lorimer Davidson. What happened next is one of the most famous conversations in investing history. Buffett peppered Davidson with questions for 4 straight hours. He wanted to understand everything about GEICO's competitive advantage, its cost structure, its growth potential. Davidson later recalled being stunned by how sharp this young man's questions were. Buffett left Washington, D.C. that day completely convinced. He went home and invested $10,282 in GEICO stock, roughly 65% of his entire net worth at the time. Let that sink in. A 20-year-old put nearly 2/3 of everything he had into a single stock. That is not reckless gambling. That is concentrated conviction based on deep research. Buffett understood the business model, understood the competitive advantage, and believed the price was far below the company's intrinsic value. He sold about a year later in 1952 for roughly $15,259, a 50% gain. Buffett would later call selling GEICO one of the dumbest mistakes of his career, because had he held on, that $10,282 would have been worth millions. But the lesson was planted. He understood what made GEICO special, and he never forgot it. Fast forward to the mid-1970s. GEICO had expanded far beyond its original niche of government employees. It was now insuring all kinds of drivers, and management had loosened underwriting standards to chase growth. This is a mistake that has destroyed insurance companies throughout history, growing too fast by insuring risks you do not properly understand. In 1975, the bill came due. GEICO reported losses of more than $126 million in a single year. The stock price collapsed from around $61 per share to under $2. Wall Street left GEICO for dead. Analysts were writing its obituary. The company brought in a new CEO named Jack Byrne, a tough, disciplined insurance man who immediately went to work cutting costs, tightening underwriting, and returning GEICO to its roots of insuring only good drivers at low prices. And this is where Warren Buffett re-enters the story. While everyone else was running away from GEICO, Buffett saw something they did not. The competitive advantage, that structural cost advantage of selling directly to customers without agents, was still intact. The near bankruptcy was caused by bad management decisions, not a broken business model. Starting in 1976, Buffett began buying GEICO shares at prices around $2 per share. This is the textbook definition of being greedy when others are fearful. Over the next several years, Berkshire Hathaway invested approximately $45.7 million in GEICO stock. By the mid-1990s, Berkshire owned roughly half the company. That $45.7 million position had grown to be worth approximately $2.4 billion. That is a return of more than 50 times his money. In August 1995, Buffett made his move. Berkshire Hathaway offered to buy the remaining 50% of GEICO that it did not already own for approximately $2.3 billion, paying about $70 per share. The deal closed in January 1996, making GEICO a wholly owned subsidiary of Berkshire Hathaway. Remember, Buffett had first bought shares of this company at around $2. Now he was willing to pay $70 because the value had grown even faster than the price. He was not overpaying. He was acquiring a compounding machine. And that is exactly what GEICO became. Under Berkshire's ownership, with the brilliant Tony Nicely running operations, GEICO went from roughly 2.5% market share in the U.S. auto insurance market to over 14% by 2024. The famous GEICO advertising campaign launched in 1999 and became one of the most recognizable mascots in American business. But the advertising worked because the underlying economics worked. Lower costs meant lower prices. Lower prices attracted more customers. More customers created economies of scale. The virtuous cycle just kept spinning. Think about the full arc of this story. Benjamin Graham invested $712,000 in 1948. That turned into more than $400 million for his shareholders. Warren Buffett invested $45.7 million starting in 1976 and ultimately acquired the entire company. Today, GEICO generates billions of dollars in annual premium revenue and remains one of Berkshire Hathaway's most important subsidiaries. Here is the principle I want you to take away from this story. Great investments are not complicated. They are simple businesses with durable competitive advantages, bought at reasonable prices, and held for a very long time. GEICO sold insurance cheaper than everyone else because it did not pay agent commissions. That advantage was obvious in 1948 when Graham bought it. It was obvious in 1951 when Buffett visited. It was obvious in 1976 when the stock was at $2. And it is still obvious today. The investors who profited did not need a complex algorithm or insider information. They needed to understand one business deeply and have the patience to let compounding do its work. As Buffett himself has said, price is what you pay, value is what you get. Graham paid $712,000 and got a fortune. Buffett paid $45.7 million and got an empire. Both of them understood the value. If this story changed how you think about finding great businesses, hit the subscribe button. Every day on this channel, we break down the principles of value investing using real stories, real numbers, and real lessons from the greatest investors in history. Tomorrow, we are looking at another fascinating case study, so make sure you do not miss it. Drop a comment below. If you could have invested alongside Graham in 1948 or Buffett in 1976, which would you choose? I would love to hear your answer.